On July 25, the Indian capital markets were rocked by a dramatic turn of events. The Securities and Exchange Board of India, known as SEBI, issued a sweeping interim order against Jane Street, a US-based trading giant renowned for its algorithmic strategies and global reach. The allegations were stark. Jane Street was accused of orchestrating a sophisticated scheme to manipulate the Bank Nifty Index, one of India's most closely watched financial benchmarks. According to SEBI, the firm's maneuvers led to artificial inflation and subsequent deflation of the index, misleading countless retail investors and reaping an estimated $550 million in unlawful profits. In a decisive move, SEBI barred Jane Street from participating in India's securities market and seized the gains, placing them in escrow as the investigation unfolds. But how did a crackdown targeting a foreign trading firm unleash such a tidal wave across Indian markets, inflicting heavy losses on local companies, including those not under direct scrutiny? To understand the far-reaching impact, we must first examine the intricate web of relationships and dependencies that define today's capital markets. The first domino to fall was Nuvama Wealth Management, Jane Street's local trading partner. Despite not being named in SEBI's order or accused of any wrongdoing, Nuvama's shares nosedived by over 11% in a single trading session. The reaction was swift and severe, reflecting the market's heightened sensitivity to perceived risks, even when the factual basis for those fears is thin. Investors, wary of potential knock-on effects, rushed to reduce exposure. This phenomenon, where sentiment drives action as much as substance, is a hallmark of modern financial markets. The shock didn't stop with Nuvama. The Bombay Stock Exchange, or BSE, India's oldest and most prominent stock exchange, saw its shares fall by approximately 6%. Angel One, a leading digital brokerage, suffered a similar fate. Even Central Depository Services, India Limited, better known as CDSL, wasn't spared, registering a 2% decline. In total, the market capitalization loss approached a staggering 12,000 crore. A sharp reminder of how interconnected and fragile the ecosystem can be. So, what triggered SEBI's crackdown in the first place? The regulator's investigation zeroed in on trading patterns around the Bank Nifty Index, which is a barometer for India's banking sector and a favorite among traders in the derivatives market. According to SEBI, Jane Street deployed complex trading strategies designed to create artificial price movements. By inflating and then deflating the index, the firm is alleged to have misled market participants, particularly retail investors, who took positions based on what appeared to be genuine market signals. The authorities labeled this a sinister scheme, underscoring the seriousness of the charges. The scale of Jane Street's alleged activity is significant. As a global player with deep technological prowess, the firm's presence in India's futures and options segment brought both liquidity and complexity. Its sudden exit, enforced by the regulator, has raised immediate concerns about the health of the market. Traders and analysts now worry about a potential reduction in market depth, meaning there could be fewer buy and sell orders at any given price point. This, in turn, can lead to increased volatility, wider bid-ask spreads, and a less efficient market overall. But why did Jane Street's global activity have such a pronounced impact on Indian markets? The answer lies in the nature of proprietary trading and the role large firms play in shaping market structure. Proprietary trading, or prop trading, refers to firms trading on their own behalf, using their capital and strategies rather than executing orders for clients. Firms like Jane Street are often at the forefront of this space, utilizing high-frequency algorithms, statistical models, and cross-market arbitrage to generate returns. Their activity provides critical liquidity, helping ensure that markets function smoothly and efficiently. When a major participant like Jane Street is suddenly removed from the equation, the effects are felt immediately. Trading volumes can dry up, price discovery becomes less robust, and the risk of sharp, unexplained price moves increases. For Indian intermediaries who rely on a steady flow of trades, whether as counterparties, service providers, or infrastructure operators, The loss of a big player means not only reduced revenues, but also heightened uncertainty. Take Nuvama Wealth Management. As Jane Street's local partner, Nuvama facilitated trades and provided access to Indian markets. When news broke of the regulatory action, investors feared possible disruptions to Nuvama's business model, potential reputational damage, or even future regulatory scrutiny. The share price plunge, while arguably overdone, reflected these layered anxieties. Similarly, the Bombay Stock Exchange and Angel One faced investor jitters. For the BSE, the prospect of lower trading volumes threatens both fee income and its status as a preferred venue. For Angel One, which caters to a large base of retail traders, any hint of instability in the derivatives market raises questions about growth prospects and risk management. Even CDSL, which handles the electronic storage of securities, was not immune. A slowdown in trading activity could translate into fewer transactions, impacting its bottom line. These reactions underscore a crucial lesson. In times of uncertainty, perception can be as powerful as reality. Markets are driven not just by hard data, but by expectations and fears about what might come next. This is especially true in an era where news travels instantly and investor confidence can shift in a matter of minutes. Looking ahead, SEBI's crackdown has ignited a broader debate about the future of proprietary trading in India. On one hand, regulators are under pressure to tighten oversight and prevent manipulation, ensuring that retail investors are protected from predatory practices. On the other, there is recognition that sophisticated firms like Jane Street play a vital role in providing liquidity, enhancing price discovery, and supporting the overall efficiency of the market. Striking the right balance will be critical. Too much regulation risks driving away legitimate players, reducing market competitiveness, and making India less attractive to global capital. Too little, and the door is left open for abuse. Industry insiders are now calling for clearer rules, more transparent surveillance, and a collaborative approach between regulators and market participants. The events of July 2025 are a stark reminder. The structure and perception of markets are inextricably linked. A single action, especially one involving a high-profile global player, can set off a chain reaction, with consequences that reverberate far beyond the immediate target. For investors, intermediaries, and regulators alike, vigilance, adaptability, and trust building will be the keys to navigating this volatile new landscape.